Okay, so you're obviously watching this video because you are a beginner investor and you're trying to figure out probably what should I invest in? Where do I start? There is so much out there, I'm lost. Well, first off, there's mutual funds, there's ETFs, as well as stocks, and there's obviously a few other things thrown in, but those are the three major things that you'll probably see at the beginning of your investment journey. And when it comes down to it, the most highest risk thing, technically speaking, is investing in stocks because it's a single stock. Meanwhile, with mutual funds and ETFs, they're a bit safer because they're generally holding multiple stocks. So if one goes down, it doesn't exactly bring the whole ETF down all at once, unless it's a massive holding of that ETF. Now, don't worry about that just as of yet. Is investing scary? Well, it can be, but I'm going to tell you that it's actually quite interesting. It's a lot of fun, and it's actually very easy after you get a hang of it. Now, what will you need to do to start investing? You're going to need to have an investing app. You can get this usually from your bank. And basically, you would just sign up for an account. In Canada, there's multiple different types of accounts where there's a cash account as well as a margin account. And with those, you are generally going to have to worry about tax implications. If you make money on stocks, you're going to obviously pay more taxes. And if you, of course, make dividends, you're going to get taxed as well, but dividends are taxed differently at a lot lesser of a percentage. Now, there's also TFSAs in Canada, and there's also RRSPs, RESPs, a whole bunch of other stuff. But if you're an adult, what you're going to need to worry about is TFSAs, tax-free savings account, and RRSPs, which is your registered retirement account. RRSPs are going to be basically very simple. You put money in there and it's tax deductible because it's basically stuck in there, and whatever you make in that account is not technically taxed, but it's taxed when you take that money back out, let's say 40 years from now. However, with the TFSA, it's not taxed at all, and I would definitely say to start your investment journey, if you're Canadian, with a tax-free savings account. Now, one of the best ways that you can invest at first is to buy into a index fund or an ETFs in general. Basically, what you're looking at here is an index fund, and with an index fund, it's covering the whole entire market. So essentially, if the whole market goes up, this will also go up. If the entire market goes down, then guess what? This is also going to go down. However, if you're betting on, in this case, the American dream, and the fact that even if there is a recession, you're not going to have to worry because 10 years down the road, you're going to be having your money back anyways, then this is a fantastic way to invest. Now, SPY mirrors the American stock market. There's others that mirror the Canadian TSX as well. And keep in mind that this is an ETF that is on the New York Stock Exchange, so this is actually in American currency. Something to really look at when you start investing in ETFs is the yield as well as the expense ratio. Same as mutual funds. Mutual funds expense ratios are usually between 2 and 4% in most cases. And of course, you can see here with an index ETF, you're paying a heck of a lot less than that 2 or 3% than that mutual fund is going to be charging you. And when it comes to an ETF, it's other people investing your money for you, which means that they want to get paid for making you money. And every ETF is different. Some will be upwards of 1%. Most of them are going to be somewhere between 0.2 and 0.6 or 0.7%, depending on the style of ETF. More actively traded ETFs that should make you more money are a little bit higher management fees, while ones like an index fund are going to be on the smaller end, 0.6, 0.9, 0.06, 0.09, 0.01. Small management fees, just because it's usually a computer that's doing it, and it's just something automatic. The market moves, the ETF just copies it, and it's not exactly a ton of man work and manpower to be able to run stuff like that. So the more manpower, the more expensive the ETF is going to be. And when it comes down to it, that percentage will technically stay the same. However, the amount of money they pull from you will change. So for example, if the ETF goes down in value and your money goes down in value, then you're technically paying less MER or less management fees. However, it's the same percentage, and vice versa. If the stock market goes up, then of course the management fees percentage-wise stays the same, but they'll be taking more money from you because you've got a larger pile of cash than you did before, and it's the same percentage. And it really does add up, because if you invest, let's say, $10,000, and in my opinion, your first $10,000 should be just into a broad market index fund anyways, just so that you can kind of get the gist of how the market works. And when it comes down to $10,000, if you're looking at a mutual fund that takes 2.5%, which is the last mutual fund I ever purchased was 2.5%, on $10,000, you're going to be looking at a massive $250 taken from you every single year. And of course, if the price of the fund goes up, then of course they'll be taking even more money from you. However, on the flip side, if you put $10,000 in and they're only going to be charging you, let's say for example, that 0.09%, at 0.09%, you're actually only going to be paying them an absolute massive $90, which is actually like basically, $9. I needed to correct myself there. $9 instead of $250. So that is a massive difference. Would you rather hand over $250 or $9? That is the question you have to ask yourself. If a bank representative or somebody is trying to sell you, or an insurance company or whoever is trying to sell you a mutual fund, definitely take a good look at them and ask them, what's the management fee? If they're saying it's over 0.5%, it's definitely something not to think about. Unless they're giving you massive returns in the past, something like maybe an 8 or a 10% dividend per year, and of course, something that's got massive better returns than an average of 6 to 8% return. If they've got something like 20 or 30%, okay, I'll pay more money to get a bigger return. But we also have to remember that whatever happened in the past is not necessarily going to tell us what happens into the future. Something else I like to look at is, of course, the chart. And obviously, when we're talking about SPY, this is essentially how the stock market moves. You're never going to see, and we've never seen, a stock market that goes to zero, other than that one time back well over 100 years ago where it basically bottomed out. But we have more fail-safes now than we did back then. And to be brutally honest with you, guess what? Stock market's still around, even though it basically bottomed out to zero, and look where we're at today. And this is what I'm talking about when it comes to ETFs and mutual funds. They'll hold some of the different companies, depends on the strategy behind that ETF. But when it comes to the SPY ETF, it's the biggest companies in the United States. So you're going to be investing in Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Berkshire Hathaway, Tesla, Nvidia, JP Morgan, some of the strongest, biggest companies in the world. When you're investing into an index fund, that's the percentage. So for example, if you put $1,000, for example, into this ETF, about $59 of it would go to Apple stock. And what I'm talking about is, when I'm talking about different types of ETFs, different strategies. For example, this one, which is ARK Genomic Revolution ETF. It's an ARK ETF. You've probably heard of Cathie Wood, and she's fantastic. This one, you'll find a fund summary on every single ETF. And for example, this one invests and basically seeks long-term growth of capital. The fund is an actively managed, exchange-traded ETF that will invest under normal circumstances, primarily at least 80% of its assets in domestic and foreign equity of companies across multiple sectors, including healthcare, information technology, materials, energy, consumer discretionary, that are relevant to the fund's investment theme of the genomics revolution. And this is actually an ETF I invest in myself, and there's a reason behind it. And that is because of the technology that companies that are basically using is CRISPR technologies. So we've all heard of mRNA vaccines. Obviously, that's the big rage, what's happening right now. But there's actually a future technology that isn't being out there in the world and out there in the wild just as of yet, because it's currently going through testing, and that is CRISPR technologies. mRNA changes your RNA, while CRISPR changes your DNA. Basically, the ability to be able to make you immune to essentially anything, including cancers, including pretty much anything, including death even. So that's the whole idea behind this specific ETF. Now, why I'm showing you this one is just basically to say, hey, there's ETFs that will really cover literally anything that you are interested in. For example, I'm interested, I would love to live forever. CRISPR technologies may be able to do that in 50 years. I would be around 80 years old in 50 years, which means that maybe they might be able to bring me back down to the age of 20 or 30. I'm currently 31. And of course, that would be fantastic. That's the idea behind CRISPR. It's actually a really cool technology. You should probably look into it if you're a geek like me. But because it's an actively managed ETF, it is 0.75 MER, which means that for, let's say, just to make math easy, for every $1,000 that you put into the ETF, you're essentially going to be paying them about $75 a year. However, again, the more money that goes up in value, or the higher that goes up in value, the more you'll be paying them, but it'll be the same percentage. This is one of those ETFs that's a long-term hold, for me anyways, because of course, when you're talking about this ETF, they're talking about it being a potential $10 trillion company by the year 2035, and it's nowhere close to that today. That would be like a 100x return on this, which is insane. Now, I'm not saying go pile your money into something like this. Basically, you always want to have some riskier investments, but you don't want to basically just throw the kitchen sink at it. What you want to do is to have at least maybe 5 or 10%, and some people's risk tolerance is a bit higher. They'll put 50%, 80% in more riskier stuff. But when you're talking about this, there is a lot of, I would say, medical tests that are currently happening in this field that are passing and are going through the system. Plus, with Biden and many other liberals and Democrats and things like that going into office, what you're looking at is more of them wanting to invest in this style of medicine, which is very good for obviously the sector, but for anyone who is looking for a shortcut essentially to be healthy. They're going to be able to make a vaccine someday for cancer, and that's going to be insane. Now, when we start looking at stocks, you don't have to worry about an MER because there is no MERs when we look at stocks. Now, this is Tesla, which is, again, in my opinion, a riskier stock. I do hold it myself, but it is technically a riskier stock just because of the sheer volume that gets traded with it, but also the volatility, and I'm going to get to that in a second. So this is the chart, and of course, this looks very, very good. This doesn't look very good because it looks like it's basically trading sideways, but believe me, this was not trading sideways. This is just looks like it's trading sideways because this increase was just so ridiculous. Now, see what happens with stocks like this is people will start buying too late. And at this point right here is what we call FOMO, fear of missing out. And there's a lot of people who will buy here, and they'll basically, when we're starting to look at the small parts of the chart like this, what will happen is they'll see the increase, and then what they'll do is they will start buying right here. And then they'll see that it dips, and they'll get worried, and it dips again, and they get worried again, and that's when they sell. And then, of course, the stock rises. And then they say, oh, well, look at it. I'm going to start buying it again right here. And then it dips. And then they start selling it, and they say, well, that stock's worth nothing. The stock market's trying to screw me. And they start getting all upset about the stock market. When the stock is usually going up like there is no ceiling, well, guess what? Don't buy it. because it's going to come back down. Every single stock does that. Now, there's actually a name for this, but I call it the stock jinx. And what I'm talking about is this. Let's say you've got a stock that's trading like this. All the lines are pretty much just linking all together, and then all of a sudden one day it jumps up here. Let's say this was a $5 jump. And then the lines keep on going, connecting every single day. And then all of a sudden there's some bad news. There's always bad news coming out. And then what you'll see is a little small drop. And then because there's this gap, that gap needs to be filled. Every single time that gap needs to be filled. And what happens? That happens. They need to fill that gap. I don't know if it's a psychological thing, but it's just a chart thing. Anytime you see a massive gap, which is what we were seeing a lot of here and here, well, guess what? They needed to fill that gap. At least one of those gaps need to be filled. And that's what happened here. Whenever you see a stock gapping up, don't ever buy it that day it's gapping up. Unless you're wanting to be risky, like the GameStop trade, and you could see it gap up to $50 and you could have been like, wow, oh my God, it's going to the moon. But there's also a psychological issue with that too, because if you get into a $50 stock, it just gapped up from 20, and you're like, oh yeah, and then it gaps up again to like 200 and then 300, and you're like, oh my God, this thing's going to $1 million. Well, guess what? Nothing ever goes up to insanity. It goes up to crazy stupid, but it doesn't go up to crazy insanity, which means that that stock will drop back down. And GameStop is still doing very good when it comes to the stock market, but it's nowhere close to where it was. So always, if you're wanting to do a bet, a call option could have been a better option or a better way of making money there, because you're risking less money than you would have been if you just went into GameStop stock. But again, call options are even more riskier. This is a beginner video. I'm not talking about options there. Just don't do them if you're a beginner. Something else to really look at is earnings and financials. This is extremely important when it comes to stocks. So what we're seeing here is 2017, 18, and 19, and 20 when it comes to Tesla. Same as earnings, but for earnings, this is going to be the last 4 quarters. We can see with Tesla that they beat 3 out of the last 4 quarters earnings estimates. Analysts will put estimates up on the board, and then basically if a company doesn't hit it, it's bad for their stock usually. And when it comes to the financials, there's a few things that you should really keep an eye on. So when you're talking about a solid company, or a company that's like a blue chip stock company, you want to see revenues, you want to see positive earnings. When you're seeing a growing company, usually what you're going to see is revenues that are good and strong and earnings that are generally negative. For example, Amazon was negative earnings for a very, very long time. Tesla, however, just recently had, in 2020, its first earnings positive year. Now, when you're talking about basically speculative companies like Tesla, because in my opinion they're still speculative, in my opinion, is the revenue. And that's going to really be a tell-all sign. If you've got a company that has 0 or negative revenue and 0 or negative earnings, and you're thinking that they're going to be a solid bet, that is a very risky bet. However, if you're looking at a company like Tesla, which in my opinion is speculative, and you're looking at it and you're seeing, wow, they're making, in 2017, they were doing $12 billion in revenue. And now in 2020, they're doing close to just over $31 or $32 billion. That's a 3x increase, and that's positive revenues in the billions of dollars. And it's all about cash flow. Cash flow, whether you're an individual or a business, is extremely important, because when you have cash flow, you will always have investors and people willing to lend you money, because that means that you're making money, so they'll always be able to get theirs back. If you have a company that has negative revenues and negative earnings, or 0 and 0, you essentially are investing in a company that is worthless because they have no tangible assets. They may have a couple of computers, but they got nothing. If a company's not making anything, they are not a company. They are basically looking there to make money off of investors and hope in the future that they could make money off of their ideas. And it depends on how risky you really want to be. If there's no revenue, I don't invest in a company that has no revenue, because with no revenue is king. Let's just put it that way. Rev is king. Now, as an example, a very solid company in Canada, at least, is TD Bank, and that is a very strong company. They pay a dividend. They pay a dividend that's probably going to be increased substantially next year, as soon as they're going to be allowed to increase their dividend. Government is currently holding them back. They trade at a high volume. You never want to look at a company and say, wow, they're only trading at 1,000 shares and I'd like to buy 2,000 shares. It's going to be forever to be able to buy that company and forever to be able to sell that company. And PE ratio is something else that you would want to look at. But the thing with PE ratio is it's price to earnings. It's a good way to gauge a company, but you can't really gauge it versus other businesses, just other similar companies. For example, there was Tesla, which their PE ratio is well over 300. And there's also TD Bank, that their PE ratio is 9. 300 versus 9. 9 being way, way cheaper of a company. However, you're looking at Tesla, and Tesla being a speculative company in a way, but massive future growth because they've got the potential robot, they've got massive artificial intelligence potentials. They're the largest AI company in the world. They are the largest electronic vehicle company in the world. They're close to the top solar panel company. They're one of the biggest battery companies. They have a lot of growth that's going to happen. However, when you're talking about a bank, they can't just go out and say, hey, we're going to make like 20x our money next year. No. What they're doing is using money to make money, and when they do that, they pay a dividend to their investors, and that's essentially what a bank is. They just essentially make money for people. And we can see that their charts really do show that they just don't really do a ton. Recently, they've had massive increases, but you're not going to be seeing a bank that is going to be going up and doubling their value over a single year. What you're going to be looking at is a bank that generally, Canadian banks go up between 3 and 8% a year, generally around 5 or 6% on average, and they pay around a 4%, 5% dividend, depending on whenever they can finally up their dividend again. And when you're talking about that seems like a pretty solid company to invest in, because it's a bank. They're going to be making money off of everything. People who don't have money, they make money off of them by charging them bank fees for not having money in their account. When you're talking about rich people, guess what? The banks make a killing on them too, because they are going to be looking at the bank saying, give me money so I can make more money off of your money, and then I'll give you your money back eventually with a little bit of a premium on it called interest. And guess what? They're going to be making money no matter what. That's essentially how it's gone. They've got credit cards now. Most banks, like BMO, for example, is creating ETFs. Like, they're just going to be making more and more money every single year off of their customers. That's what a bank is. People think that they're just keeping their money there and keeping it nice and safe, and the CEO is petting their money every night. No, that's not how banks work. Their business is to make money off of you. So we might as well make money off of them for making money off of you. That's essentially how it works. Anyways, I hope that you've enjoyed today's video. If you have, I hope that this video has actually helped you become a better investor or learn how to invest. If it has, hit that like button, subscribe. I'll see you guys again next time.